Hello, everybody. Thanks for taking time out of your day to join us for today's master class. It's our very first one here at URL for the year. In today's topic, we're going to be talking about protecting your client's Social Security income using life insurance. My name is Matt Alina, and I am the manager of the Life Markets team here at URL. And we've made a dedicated and a concerted effort to providing different trainings throughout the year to help you better serve your clients and also for us to be able to better serve you. So today, as I mentioned, we're going to be talking about protecting your client's Social Security income using life insurance. Let's take a look right now at the current lay of the land as to what Social Security is and just kind of what it's been in the crosshairs through many different presidential administrations. It's been talked about, is Social Security going to be there? Is it not going to be here when we retire? And it's not that's not what we're going to be talking about today. But what we'll be talking about is that right now we're looking at, I think we've just surpassed $34 trillion in national debt. And one of the things that really kind of irks me, probably irks you as well, I've been paying into Social Security since I got my very first real paycheck. I'm sure you have too. We've been paying into the system since the very first job we had, and with the intent that with the thought that that would then pay us when we decide to retire. Well, our government views Social Security, those Social Security monthly benefits uh, that they pay out, as entitlement spending, and so not to talk about what entitlement spending is, but and what it does. But the fact of the matter is, if there's a way that they can turn the faucet off for income for your clients, for those Social Security recipients, they're going to try to find every which way that they can to try to save some money. After all, $34 trillion in debt. So we're going to show you today how to use life insurance to help protect Social Security. So you're probably wondering, how is life insurance going to protect Social Security income? Stick with me here. It'll all make sense here. So when you're meeting with clients, married clients, and one of their main sources of income is Social Security, when one of them dies, the surviving spouse gets to keep the greater of the two benefits. We'll show you how that works here momentarily. So, if one person is making $2,000 a month and another person is making $1,000 a month, collectively, they're making $3,000 a month in Social Security income. When one of them dies, that $1,000 goes away, and the surviving spouse gets to keep the $2,000 until they pass away. For many of our clients, for many of us, losing $1,000 of income a month, you're going to feel it. Whether you're widowed or not, you're going to feel it. So how do you use and how do you lead into having a discussion about using life insurance to protect that Social Security income? They say that money can't buy time, or that you can't buy time, but I'm going to tell you, by the end of today's presentation, you'll see exactly how money can buy time. When you're sitting down and you're talking to a client, you're going to ask them some rhetorical questions. Get out a clean sheet of notebook paper and draw a T, a T diagram. One side will be for the husband, one side will be for the wife. And you're just going to ask them, are you currently receiving Social Security income benefits? You know that if they're over 65, 70, and you're sitting down and you're meeting with them, chances are they're probably taking those Social Security income benefits. You're going to be nodding your head. Are you currently on Social Security income benefits or receiving Social Security income benefits? Yep. And then you ask them again, do you know how Social Security income benefits work when one of you dies? Do you know what happens to your Social Security income benefits when one of you dies? You're going to reiterate it. You're going to tell them anyway. And you're just going to say, their surviving spouse, between the two of you, whoever survives, you get to keep the greater of the two benefits. You lose the lesser benefit. Now, ask them this question. When this happens, is it going to be financially debilitating for you? You're going to nod your head because you know it is. They're going to feel it. It doesn't matter if they have a lot of money or not. They're going to feel that. They're going to feel the pinch. Obviously, for people that are very wealthy, Social Security is not something that it's nice to get it, but it's not what they're living on. It may pay for a few things or whatever. They may just sock it away and put it into their savings or whatever. But for a lot of people, they rely heavily on their Social Security income. So when you're talking to somebody, you're going to ask them that question knowing full well they're going to feel that financial pinch when this happens. It's not if this happens, it's when this happens. Is it going to be financially debilitating for you? So once you say that, here's where you're going to be the bearer of good news. I have great news. I have good news. There is a state approved Social Security income protection plan that is backed by a simplified issue, no exam life insurance policy that will allow you to keep that income coming. I have good news. There's a state regulated or a state approved Social Security income protection plan that is backed by life insurance that will allow you to keep that income. Now, for you and for me, can any life insurance policy do this? Yes. Why are we pushing towards simplified issue, no exam? We want policies that are issued quickly, and we want policies that are going to be issued without a lot of hassle. Exams, these lengthy underwriting questions, they just are a deterrent for a lot of people. So again, that's why we push towards the simplified issue route, more or less the final expense route, the whole life route. You can use simplified issue term plans. Keep in mind that term plans will terminate. So if they outlive that term, there's a problem. There's also simplified issue whole life, simplified issue universal life. It really depends on the age of your client and their health. To just not muddy up the waters, we're going to be talking today about simplified issue whole life, aka final expense. That's going to be how we use this as an example. When you're talking to people, do not assume that the client knows more than you. You want to take them down this path, and you're opening up their eyes, something that they may know, but they really haven't given it much thought. One of them is going to go. We don't know who's going to go first, but one of them is going to die. We all die. Our job is to protect the lesser benefit amount. I'll show you how that works here momentarily. Our job is also to try to answer the questions before they come up and try to be one step or a couple of steps ahead. You want to take them down this journey. First of all, you're talking to them and you're opening up their eyes to the fact that they know it, but they really haven't talked about it. Talking about the fact that at some point one of them is going to die, someone's going to be first, and that their Social Security income, their household income is going to be financially impacted, and you're there to help open their eyes and see that there are ways to still protect that income to help buy them some time. So I came up with a couple of different cartoons here. I'm going to introduce you to my in-laws. There's a couple of cartoons here. One of them, it says two men were in the pub. One says to his mate, "My mother-in-law is an angel." His friend replies, "You're lucky. Mine's still alive." And then there's the other one, basically, and this is a conversation that I will sometimes have with my wife if we're going over to her parents' house or if they're coming over, basically saying that we need to know, we have to have an out. We're not going to spend endless hours there. So just a couple of cartoons, just to kind of lighten the mood so much, somewhat here for you. So let me introduce you to my in-laws. I've changed around some of the facts here, but my father-in-law is Ben. My mother-in-law is Pat. Ben's a year older than Pat. So in today's illustration, we're going to say that Ben is 68 and Pat is 67. Ben worked for the state of Pennsylvania, and he gets a little bit of a pension, and he's receiving income from Social Security. Maybe he's a Medicare client of mine. He's not, but I don't personally sell the Medicare stuff. But he receives Social Security income. His Social Security income is $1,500 a month. Now, my mother-in-law, Pat, she was the breadwinner in the family. She's a retired pediatric nurse practitioner, worked for private practice, did very well when she was working financially. She doesn't get a pension. She has a little bit of a retirement that she set up years ago, but her Social Security income is $3,500 a month. So collectively, combined, they're receiving $5,000 a month in monthly Social Security income benefits. Our job, my job, meeting with my in-laws, is to protect that lesser benefit amount. I've had this conversation with them. You know that when one of you dies, their surviving spouse is going to be able to keep the greater benefit of $3,500, but that lesser benefit, the $1,500, is going bye-bye. I have a way to protect, through life insurance, through the state-regulated program backed by life insurance, a way to protect that $1,500 a month. If you lost that $1,500 a month today, would you feel it? Of course you would. So let me ask this rhetorical question. Let's say somebody gave you, and you can use this question for your clients. If somebody came into $1 million, would you spend $100,000 to protect the other $900,000? Of course you would. Same thing if you said, if you had $100,000, would you spend $10,000 to protect the other $90,000? Of course you would. That is the concept of a dime to protect the dollar. You're taking 10% of whatever benefit amount to protect the other 90%. A dime to protect a dollar. Obviously, a dime is 10% of a dollar. So, talking and sitting down with my in-laws, Pat and Ben, we wanted to protect that $1,500 a month. What's 10% of $1,500? It's $150 a month. So we're going to take $150 for Ben and $150 for Pat. Collectively, it's $300 a month. Collectively, it's 20% of the lesser benefit. Why? Why do we do that? Because we don't know who is going to pass away first. Is Ben going to die first? Or is Pat going to die first? We don't know. So we're taking $150 for Ben, $150 for Pat. We take the $150 a month for Ben, who healthy-ish, non-smoker. He's got some pre-existing medical conditions. He had prostate cancer several years ago, but he's survived that. And we're able to get him through Transamerica a benefit of $24,460. Now, that $150 a month benefit actually buys Pat through Mutual of Omaha a policy for $34,412. So we don't know who's going to go first, but if Ben passes away first, Pat is going to get $24,460. It avoids probate. It avoids taxes. She gets that money free and clear. Now she can draw $1,500 a month from that $24,460 benefit. That'll extend that income for 16 months. What does that do? It helps her buy time. It helps her so that she doesn't have to make knee-jerk reactions and knee-jerk purchases and knee-jerk decisions. She can still make her mortgage payment if she has a mortgage payment. She can still kind of maintain her current lifestyle and get things figured out and she's got 16 months to do it. Maybe she sells the house, maybe she downsizes, maybe she sells a few things. She's able to get her finances in order. If Pat dies before Ben is going to get $34,412, avoids probate, and it's tax free. Now, Ben can actually draw $1,500 a month from that benefit for 22 months. So that actually buys him 22 months of time to get his financial affairs in order. Same thing. He can use that to continue to make those mortgage payments, can help so that he doesn't have to make any split second decisions. These are decisions that are life altering. Not only that, but when you lose a spouse, your finances are probably one of the last things on your mind. This just provides additional peace of mind. That is how you use a simplified issue whole life policy, a final expense policy, to help protect Social Security income. Now, you do want to try to avoid some objections before they come up. And I mentioned this at the beginning of our presentation today, like why a simplified issue whole life? Can you use a simplified issue term? Yes. Can you use a simplified issue universal life or one of those programs? Yes. But the reason we kind of gravitate and kind of promote the simplified issue whole life is that it is a quick issue plan with lifetime guarantees and very limited underwriting. Most people can qualify for one of those final expense plans. Can I pass this on to my kids? Absolutely. Just like any life insurance policy, the person that has the insured, the owner of the policy, has the luxury of naming any beneficiary that they want. So if Ben passes away before Pat can keep her policy, and now she can name her children or her grandchildren or great-grandchildren as the beneficiary as a gift if she wants to keep that going. She doesn't have to, but she can. What if they say, I already have life insurance? That's great. You know that the person that they already know how to pay premiums. They're already paying premiums. This program is designed to protect your Social Security income. Let your life insurance policy do what your life insurance policy was marked to do, what your purpose was already designed for that policy. If it was to pay off a mortgage or to pay off some debts or leave money behind for family, friends, whatever, let that policy continue doing what it's doing. This is just a supplement and just to protect your Social Security income. Some people are going to tell you just automatically, I can't afford it. Well, you know that they can. You may have to help them see where they have some wasteful spending. But at the same time, you just reiterate the fact that all we're doing, Pat, all we're doing, Ben, is taking 10% for each of you to protect the other 90%. It's either you do a little bit of something now, 10% now, or you're losing 100% of it down the road. So taking 10% for Ben, 10% for Pat, dime to protect the dollar, to protect the other 90%, technically 80%, because we don't know who's going to pass away first. Fast forward, after I had this conversation with my mother-in-law and father-in-law, couple of years ago, Ben passed away. And that income, that $1,500 a month Social Security income, went bye-bye. Let me ask you this question. Do you think my in-laws did this Social Security protection plan? No, they didn't. Now, I mentioned my mother-in-law has a little bit of retirement, and she's receiving the lion's share of her Social Security benefits of $3,500 a month. Does she feel the loss of $1,500 a month plus the small pension that Ben received from the state? Absolutely. She feels it every month. Does she wish that she did that protection plan? Yes, she sure does. She feels it every month. And a lot of your clients are going to feel the same thing. They may have made some really good money during their working years, but even $1,500 a month when you are on a fixed income, like my mother-in-law is, losing $1,500 a month, you feel the pinch. She feels the pinch. She has to be a lot more aware of what she's spending her money on every month. And some of those luxuries that she was able to afford when Ben was still here, those luxury items are not affordable anymore for her. She likes to get her nails done. She likes to get her hair done. Those are luxuries that she used to do it on a regular basis. Now she has to cut back because she has all those expenses of still maintaining the home and everything that goes along with it, with $1,500 plus a month less in income. So let's summarize what the Social Security Protection Plan is for this master class. Is ask your clients if they have heard of the Social Security Protection Program. Chances are they haven't. It's just a kind of a niche thing. It's a conversation starter, and explain what it is and what it does. You have to show them the value of this and do some basic fact finding. For my Medicare friends here that do Medicare, you already have an in with your clients. It's a great way to have a circle back, check in on them, and then ask them if they'd like to have a conversation about how to protect their Social Security income backed by a state regulated life insurance program. So do some fact finding, find out what their monthly Social Security income is. Show them a dime to protect the dollar. You're going to submit the applications. A lot of these applications you can submit electronically online, and you're going to get immediate underwriting decisions and deliver the policies. A lot of the policies can be sent directly to the client, or if you want them to be delivered to you, that you can personally hand deliver and say, here is your state regulated Social Security Protection Income Program. Here you go. And you can do it that way too. It all is how you want to better serve your clients. So with that, I'll take any questions that you have. Of course, you can always contact me you can contact me or my team. You can contact me directly at 717-216-8041, or you can email me at matta@urlinsgroup.com. Again, 717-216-8041 or matta@urlinsgroup.com. Hope everyone got a little bit of information here today about how to use a simplified issue life insurance policy, aka a final expense plan, to help your clients protect their Social Security income. Again, if there's any questions, anything that you need, please feel free to contact me at any time. Look forward to helping you with that.